Imagine waking up on a Tuesday in absolute silence. There's no alarm, no urgent emails, no rush. Time is yours again, not because you won the lottery, but because your money works silently every day, and each month a portion of those earnings comes directly to you. That constant flow has a name: dividends. Living off dividends isn't a fantasy, it's a financial strategy that hundreds of thousands of people around the world already use to buy the most valuable thing in existence: time. Today, we're going to break down that truth with clear examples, real numbers, and concrete steps that will allow you to visualize it in your own life. The invisible seed of money. Imagine a tree in the middle of a garden. At first, it's just a small seed, shapeless, shadeless, and fruitless. No one would stop to look at it. But if you decide to care for it, give it water, patience, and time, little by little it begins to grow. Its roots deepen, its trunk strengthens, and over the years, it begins to steadily bear fruit. The same thing happens with dividends. When you buy shares in a solid company, like one that generates stable profits and distributes part of those profits, you become a partner. And as a partner, you receive a periodic payment, which can be monthly, quarterly, or annually. That payment is called a dividend. The fascinating thing about dividends is that they are income that comes without you having to sell your shares or exchange your time for money. It's a recurring flow, which you can use to cover expenses or reinvest to further grow your portfolio. If you invest $10,000 in a group of stocks with a 4% annual dividend yield, you would receive $400 a year without doing anything else. It may seem like little, but this is where the real magic comes in. If you reinvest that $400, not only does your capital grow, but next year's dividend also grows. This snowball effect is what experts call compound interest. Now, imagine that process not with $10,000, but with $50,000, $100,000, or even more. The dividend is no longer a symbolic income. It can become the payment of your rent, your monthly expenses, or even the freedom of no longer depending on a salary. Dividends are much more than money. They are a tool for independence. They represent the moment when your money starts working for you instead of you working for money. Dividends are the invisible bridge between your savings and your freedom. That bridge isn't built in a day, but every share you buy, every dollar you invest, is another brick in that structure that will one day take you to the other side, to the side of independence. To begin planting that intention, I invite you to write in the comments the phrase, "Money works for me." Do it not just as a gesture, but as an affirmation. Because every time you say it, you begin to train your mind to understand that true wealth is not earned through endless effort, but through vision, patience, and perseverance. The number that reveals your freedom. Every person has a number. That number doesn't appear in your bank account or on your paycheck. It's a silent, invisible number, but when you reach it, your life changes forever. We're talking about your financial freedom number, the exact amount of capital you need invested so that your dividends cover all your expenses. Let's say you want to live on $2,000 a month. That number doesn't make you a millionaire, but it does give you comfort, security, and stability. Over a year, that's equivalent to $24,000. Now, if you build a portfolio that offers an average dividend yield of 4% per year, you would need $600,000 invested. When we first hear this number, it sounds huge, almost impossible. But here's the truth that almost no one tells you. You don't need to raise that amount all at once, not in 1 year, not in 5. Every dollar you sow today is a brick in the construction of that bridge. The real secret lies in compound interest. If, in addition to investing, you reinvest the dividends you receive, your capital begins to grow exponentially. It's not linear growth, it's an upward curve that accelerates over the years. If you invest $500 a month in a portfolio with an average annual return of 8%, in 20 years, you could accumulate around $290,000. In 30 years, that amount is close to $700,000. And all of this without needing to earn million-dollar salaries. The difference isn't made by the initial amount, but by consistency and time. Think of your freedom number as a personal compass. It can be $600,000, $400,000, or even less, depending on your lifestyle. The important thing isn't to compare yourself to others, but to discover your number and start moving toward it today. Because every year you put off this decision, you don't just waste time, you lose the fruits that capital could have been silently generating for you. The art of starting small. Most people get paralyzed when they hear figures like $500,000 or $1 million invested. They think, that's not for me, I'll never get that far. And that's where they make their first mistake, looking at the top of the mountain without taking the first step. The truth is, no one reaches $1 million without first going through the first 1,000, the first 10,000, and then the first 100,000. If you only have $10,000 invested today, that's already a powerful start. With an average annual return of 8% and reinvesting dividends, in 10 years, that $10,000 could turn into $21,500. And if you keep adding $300 a month over that same period, your capital could grow to more than $65,000. Now, there is a magic number on this path, the first $100,000. That's the real takeoff point. Why? Because until you reach that number, you feel like you're moving slowly. Every contribution counts, but the interest still seems small. However, once you cross that threshold, compound interest begins to outweigh your own efforts. Your dividends begin to generate more dividends, and the growth curve becomes exponential. Legendary investor Charlie Munger said it best. The first $100,000 is a child of getting it, but you have to do it. After that, it gets easier. That's the secret that almost no one understands. The game becomes interesting just after that goal. So rather than obsessing over total freedom or million-dollar figures, focus first on crossing the $100,000 barrier. Because when you get there, something will change in your mindset. You'll no longer be saving solely through your job. Your money will begin to work for you on its own. To engrave this truth in your mind, write the phrase in the comments. I accept success and happiness in my life. Make it a personal declaration, because if you manage to maintain consistency and discipline until you reach your first 100,000, the rest will cease to be an impossible mountain and become an inevitable journey. Simpler lives, closer goals. Most people associate financial freedom with the idea of having infinite money. They believe they'll need millions to be able to stop working. But the truth is that independence doesn't always depend on how much you accumulate, but on how much you actually need to live in peace. If your monthly expenses today are $2,500, you probably think you need to invest more than $700,000 or $800,000 to maintain that standard of living with dividends. But what would happen if you learned to live on $1,500 a month without losing quality of life, but rather eliminating what doesn't really contribute? In that case, your annual expenses would be $18,000. With a portfolio that offers an average annual return of 5%, you would need just $360,000 invested. See the difference? A goal with expenses of $2,500 a month is around $720,000. A spending goal of $1,500 a month is just $360,000. Reducing expenses doesn't mean getting poorer, it means getting closer to your freedom faster. Every dollar you eliminate from your monthly budget is one less year of obligatory work. True wealth isn't having everything, accumulating more things, more commitments, and more debt. True wealth is having enough to live peacefully, without depending on anyone, and with time on your side.
When you reduce expenses, you not only get closer to your financial goal, you also train your mind to value the essentials. You discover that what truly brings happiness isn't the luxury car, the designer clothes, or the lavish dinners. What truly brings peace is knowing that your life is light, manageable, and sustainable. In other words, every time you choose simplicity, you are buying freedom.
The most resilient trees. In nature, there are trees that manage to survive decades of storms, harsh winters, and endless droughts. Their roots are so deep and their structure so firm that, regardless of the climate, they remain standing and continue to bear fruit. In the financial world, such trees exist. They are called dividend aristocrats. What does this title mean? They are companies that have not only paid dividends for more than 25 consecutive years, but have also increased them every year. This means that even in crises, recessions, and market downturns, these companies have maintained their commitment to rewarding their shareholders. Examples of dividend aristocrats include giants such as Coca-Cola, which has increased its dividend for more than 60 consecutive years. Johnson & Johnson, with more than 50 consecutive years of increases. Procter & Gamble, with more than 60 years of delivering increasing payouts. Investing in companies like this is like planting a century-old oak tree. It doesn't grow quickly or promise immediate results, but once it matures, it becomes a reliable source of income that stands the test of time. If 30 years ago you had invested $10,000 in Coca-Cola, today you would not only have a much more valuable portfolio thanks to the stock's appreciation, but the annual dividends you receive could exceed $1,200. That is, each year you would receive more than a 12% return on your initial investment, not including capital growth. This is what is called yield on cost. Building a portfolio with dividend aristocrats isn't about chasing the latest fad or seeking quick profits. It's about choosing stability over speculation, planting deep roots that ensure shade and fruit for decades. The most resilient trees are not those that grow the fastest, but those that weather all storms. And on your path to financial freedom, you need to have those trees in your portfolio. Beware of golden traps. In the investment world, few things shine as brightly as a high dividend. Seeing a stock that promises to pay 10% or 12% annually can be tempting, like finding gold along the way. But let's not forget one thing: not all that glitters is real gold. A dividend that is too high, far from being a gift, can be a warning sign. It often reflects that the company is experiencing financial problems and, to keep investors' attention, promises unsustainable returns. In 2008, before the financial collapse, several banks in the United States offered dividends exceeding 8% annually. Investors believed they were looking at a money pit. However, after the crisis, these banks not only cut dividends, but also lost up to 90% of their stock market value. Those who entered because of the promise of quick payouts ended up caught in the golden trap. So, how can you tell if a dividend is truly solid or just an illusion? There are 3 essential keys. 1. Debt level. A company with excessive debt runs the risk of using borrowed money to pay dividends, something unsustainable in the long term. 2. Income stability. Dividends must be backed by a steady cash flow. If income fluctuates too much, sooner or later the payout is cut. 3. Track record in crisis. Companies that have maintained their commitment even in recessions demonstrate discipline and financial strength. That consistency is worth more than an inflated dividend. Investing in dividends is choosing patience over haste. It is understanding that wealth is not built on brilliant promises, but on firm foundations. Imagine a tree laden with fruit out of season. It may look tempting, but if its roots are weak, a storm can easily topple it. In contrast, a tree that grows slowly with deep roots will endure for decades. That's what solid dividends are: modest, constant, and long-lasting. Time as a silent partner. In finance, there's a partner who never speaks, never signs contracts, and never makes headlines, but it's the most powerful of all: time. Think of it this way. If you allocate $500 a month to a portfolio that achieves an average annual return of 8%, after 20 years, your money could turn into more than $290,000. And if you decide to extend that discipline to 30 years, the figure approaches $700,000. What's the magic behind this? It's not magic, it's the power of compound interest. Every dollar invested not only generates profits, but those profits begin to produce more profits in a cycle that accelerates over time. A simple example. In the first year, those $500 a month add up to $6,000 invested. At the end of 10 years, you will have contributed $60,000. But with the help of compound growth, your capital won't be $60,000, but almost $90,000. In 20 years, your total contributions would be $120,000, but time will have multiplied that figure to over $290,000. That means more than half of the money in your account doesn't come from your pocket, but from time working on your behalf. Imagine planting a tree that barely grows a few inches in the first few years. The temptation to give up is great because the results seem minimal. But there comes a point when that tree develops such deep roots that it begins to grow rapidly without you having to do anything more than water it patiently. That's the difference between someone who invests and waits and someone who never starts. One makes time their partner, the other their enemy. Time is fair but relentless. If you invest, it rewards you exponentially. If you don't, it also works against you. But it works against you because every year lost is a year you'll never get back. That's why you don't need $1 million salary to build wealth. What you really need is perseverance, discipline, and the determination to start today, even if it's with little.
Smart tax strategy. Investing in dividends is exciting. Seeing your money start working for you is a first step toward financial freedom. But there's one detail many forget: taxes. In most countries, dividends are taxed, and if you don't plan for them, a significant portion of your earnings can be lost before you even see them. The real question isn't just how much you earn, but how much you get to keep. If your portfolio generates $10,000 a year in dividends and the tax rate is 20%, you would lose $2,000 in taxes alone. That's money that's no longer working for you. But with smart tax strategies, you can legally reduce that impact. 1. Tax-advantaged investment accounts. Some countries offer savings or investment accounts where dividends grow tax-free until you withdraw them. 2. Automatic reinvestment ETFs. These funds reinvest dividends without generating immediate taxes, accelerating compound interest. 3. Strategic planning. Choose assets based on your country. Take advantage of deductions and structure your portfolio with tax efficiency in mind. Tax education is just as important as financial education. Learning to conserve your money is as powerful as learning how to earn it, because every dollar you save and reinvest accelerates your path to independence. Imagine your money as a river flowing toward your financial freedom. Taxes are like stones that block the flow. A good tax strategy acts as a channel that lets the river flow unhindered. To internalize this lesson, write in the comments, "I accept success, money, and happiness in my life." Because earning is only the first step. Conserving is where true wealth is built.
Long-term mindset. Investing isn't a sprint. It's not about making a quick profit, catching the stock of the day, or hunting for the highest dividend of the week. Investing is a marathon. True wealth is built with patience, consistency, and strategic vision. Every decision you make today, no matter how small or slow, is a building block that will shape your future. If you start by investing $500 a month in a diversified portfolio with an average annual return of 7%, in 10 years you will have contributed $60,000, but your total capital will grow to more than $85,000 thanks to compound interest.
In 20 years, those same contributions could exceed $220,000, and in 30 years, approach $450,000. Money doesn't grow linearly. It accelerates over time, but only if you maintain discipline and don't succumb to the temptation of immediate gratification. The right mindset doesn't focus on the urgent, but on the important. It's the ability to look 10, 20, or 30 years ahead and make decisions today that your future self will deeply appreciate. And the most interesting thing is that this mindset transcends the financial. Once you learn to think long-term, you apply patience, strategy, and vision to other areas of your life: relationships, health, personal projects. Every decision becomes more conscious, more measured, more powerful. Investing isn't just about building money. It's about personal evolution. It teaches you discipline, focus, and the ability to stay calm while time works in your favor. Diversification with purpose. Achieving financial freedom doesn't mean putting all your money into a single strategy or a single asset class. The key is to diversify, but with a purpose. Not all of your investment should go to dividends. In fact, a balanced portfolio combines dividends, your passive income stream, the money that comes in without you having to work; growth assets, stocks in expanding companies that increase your capital over time; real estate, properties that generate income and can appreciate in value over the long term; digital businesses or alternative investments, opportunities that, when well studied, expand your financial potential. If you build a $100,000 portfolio, you could allocate 40% to solid dividends, ensuring a stable passive income; 30% to growth stocks, seeking to multiply your capital; 20% to real estate or REITs, generating additional cash flow; 10% to digital businesses or alternative investments, exploring new opportunities. The goal is to have a portion of your portfolio that pays you to exist, regardless of what happens in other assets. That's your invisible cushion, your safety net, your guaranteed freedom. Diversification not only protects your capital, but also gives you emotional peace of mind. Knowing that a portion of your investments is working for you every month, even if other parts of the portfolio fluctuate, allows you to make calm, long-term decisions. Think of your portfolio as an ecosystem. If one area fails, the others maintain the balance. That resilience is what turns money into real freedom, not just numbers in an account. To reinforce this habit in your mind, write in the comments, "I accept success, money, and happiness in my life." Because financial freedom isn't about blindly taking risks, but about building an intelligent system that flows effortlessly, even when you're not looking. Living off dividends isn't an impossible dream, it's a life project. It's not just about accumulating capital, but about designing an existence where your time belongs to you. Because in the end, the most valuable money isn't the money you spend, but the money that buys you back your freedom. If this message resonated with you, it's no coincidence. It's because you're ready to take the next step. Subscribe and join me on this journey, because every week together, we build not only wealth, but a life of purpose.